A very happy day to all of you and welcome to my YouTube channel. I'm your learning partner Sushila Hariharan. In this module, we're going to take a look at one of the most powerful weapons of profit and powerful weapon of destruction called as leverage. Often used by financial investors across the world, asset buyers, and corporates, leverage can be a friend or a big devil in your capital structure. So let's take a look at what is leverage. How do investors across the world use leverage while trading? And how does leverage boost markets? And what happens to asset prices because of leverage? At a very basic level, leverage means the usage of borrowed funds to buy an asset. That means, let us take for example, I want to buy a house. I have savings of 20 lakhs, but houses cost about 50 lakhs. I need to borrow the remaining 30 lakhs to be able to buy the house. If I don't want to use that extra money of debt, then I have to buy the house which is smaller in size or which can fit into my budget of 20 lakhs. But by using borrowed funds, I am able to buy a bigger house which will give enough space to all my family members. Therefore, leverage is the concept of supplementing your own savings with borrowed funds in order to buy an asset. Who will use leverage in order to do this? Who will borrow money in order to buy assets? There are three different types of entities who powerfully use leverage in order to structure their investment portfolios. The first is corporate leverage. Corporates across the world are known to be very savvy in financial engineering. By using the right component of debt equity in their capital structure, they are able to exploit financial leverage to the fullest. The second kind of entity which uses extensive leverage are the retail participants. The retail participants are using leverage to buy houses, buy mortgages. They take loan against securities or loan against shares as it is known. But by taking a loan against shares, they're participating in the stock markets by borrowing funds so that they can take a larger trading position in the markets. And finally, the biggest investors of them all, called the institutional investors. This third type of entity, clubbed together as institutional investors, comprises hedge funds, pension funds, insurance companies, banks, all who come together to trade, who all come and trade in the markets. They participate extensively in the derivative segment. And if you look at the daily turnover, we can find out the derivative trades far exceeds the cash segment. Institutional investors, in fact, almost contribute to 85% of the daily trades through leveraged or margin trades. Let's look at each of them individually. Corporate leverage. The biggest question that many companies ask themselves is what should be the capital structure? Again, as already explained to you, leverage is borrowed money to supplement your own money so that you can buy a bigger asset. Why would you want to buy a bigger asset? So that the bigger asset gives higher returns as compared to buying a smaller asset. So, similarly, companies also try to answer this question of should I use borrowed funds to buy the asset so that with the borrowed funds they can buy more plant and machinery, produce more, sell more, generate higher returns for the shareholders. This is determined by their comfort levels with what should be the breakup of debt and equity in their capital structure. Should debt be equal to equity? First question. Many companies in the world follow this strategy that let debt be equal to equity. This gives some bit of comfort to both the lenders as well as to the shareholders. Should debt be higher than equity? Many investors are afraid of investing in high debt companies. But there are some companies which are inherently high debt. For example, infrastructure companies, financing companies, banks, etc. You will find that the debt levels are extremely high. Therefore, it depends upon the type of business that the company is operating in. If the company is very uncomfortable with raising too much of debt, they might choose to have zero debt in their capital structure, or sometimes have debt which is lesser than equity. This is called as financial leverage. The amount of money that you use by borrowing funds, because of which you get tax covers, you have reduced tax payouts, you have an interest cover, all contribute to the understanding of financial leverage. Let's look at the second dimension. The second set of entities who are using leverage are the retail investors who borrow money to buy assets. For them, the biggest aspect to be determined is the LTV, or the loan to value ratio. What do I mean by loan to value ratio? What is the amount of the loan versus what is the collateral value that is provided. Therefore, lenders operating in the retail loan segment ask these simple questions. Should the loan value be greater than the collateral value? What happens if the loan value is greater than the collateral value? That means the amount of commitment that the borrower has to pay is higher than the collateral that they have provided. This is a very uncomfortable sign for the lender. The lender finds that his loan is exposed to very great degree to the borrower, for which the lender does not have enough collateral. Therefore, loan value being greater than collateral value is not a good sign. Should the loan value be equal to collateral value? It can be, but again, it is at that point wherein if what happens if the collateral value starts collapsing? If the collateral value starts collapsing, like what had happened in the global financial crisis of 2008, then the lender stands exposed to very high levels of return borrowers' commitments. The third is the loan value should be ideally lesser than the collateral value. This gives enough buffer, enough comfort to the banker that when they have disbursed the loan amount is lesser than the collateral amount. For all retail loans, the number one driving factor for determining the quantum of loan is CIBIL score, followed by the LTV, or the loan to value ratio, of which the one that is highlighted in green, that is loan value should be lesser than the collateral value, is a positive indicator of the loan. If the loan value becomes greater than the collateral value, then it's a negative indicator for the bank. And then finally, the third dimension, that is the institutional investors. The institutional investors participate in stock market trades, commodity trades, foreign exchange trades, bond market trades, etc., largely through derivative trades. These derivative trades are highly leveraged trades. As we know, there are exchange traded derivatives like futures and options, which are traded on recognized stock exchanges. The participants who take a long or a short position in the particular trade pay a margin amount before initiating the trade. This margin amount is a small percentage of the contract value. Therefore, institutional investors who trade in futures and options as well as on margin trading in the stock markets or in the or in the FX markets have very high leverage trades. That is, by paying a small upfront margin, they are able to take a large position in the markets. They literally move billions of dollars through these derivative trades across the world. Is leverage always a dost? Is it always your friend? Yes, only if asset prices are increasing in value, implying that if you are borrowing at 8% interest per annum and the asset is increasing at 15% per annum, then your cost of borrowing is lower than your returns that you're getting from the asset. You should continue to use leverage. That is because you have used leverage properly, invested it correctly, and bought assets that are increasing in value. So the cost of the loan for you is much lesser compared to the increase in the asset prices. As we have learned in 6th grade or 7th grade, if cost is lesser than returns, then it is profitable for you. But too much leverage, and leverage can become a villain. It can become a devil when asset prices start collapsing. When the asset prices start collapsing, the cost of leverage becomes too high. The cost of leverage is in fact higher than the returns from the asset. Your investor is getting negative returns. Thus, leverage, which was a friend, now has become a devil. Thank you so much for listening into this channel. If you have any queries, please post it in the comments box. If there are any topics that you would like us to cover, please let us know. Your feedback is very important to my content team because they source content from various books. They speak to different academicians as well as practitioners in the industry, and they put together all the content that is displayed in this channel. Please hit the like, share, and subscribe to my YouTube channel. Thank you so much for watching in. Bye for now.